Hello friends, you must be aware of the word PPF that stands for Public Provident Fund. When you join a new job or start earning, almost everyone suggests you to invest in a PPF in order to save tax. But what is PPF? Is it really a good investment option? In this video, we'll discuss everything about PPF. But before that, a quick reminder, if you wish more videos like this, please subscribe to my YouTube channel and press the notification bell icon for more updates. And if you like the video, please press the like button. Let's get started. Today's topic, PPF. PPF, that is Public Provident Fund. It is a long-term savings scheme launched in 1968 by National Saving Institute under a Ministry of Finance. The main intention is to encourage the people to save and invest for a long period of time. Under this scheme, you will get a maximum of 1,50,000 as a tax deduction under Section 80C. This is a brief explanation of PPF. Now we are going to discuss about features of PPF. First of all, tenure, that is the time period for which you will invest in a PPF, that is 15 years. That can be extended in blocks of 5 years. It is a long-term investment scheme. Next, what is the investment limit? You can invest from 500 to 1,50,000 in a financial year. Understood? Next, joint account is not allowed in this scheme. Only one can have only one account in this scheme. Except he can open another account in the name of minor. That is only a difference that we will discuss in the later part. Continuing with the features, risk factor. It is guaranteed risk-free returns. It provides guaranteed risk-free returns because it is controlled by our government of India, and complete capital protection also it provides. That is, at the time of maturity also you will get complete protection as it is already controlled by our government of India, and hence risk factor is very low. Next, lock-in period. What is lock-in period? You cannot withdraw your balance from your PPF account until your completion until your maturity period is completed. However, partial withdrawal facility is available that we will discuss in the later part. But full amount cannot be withdrawn until your 15 years is completed. It's a longest lock-in period among other tax saving deductions, other tax saving schemes. Continuing with the features, deposit frequency, at least once in a year of minimum rupees of 500 you can invest. You have to invest at least 500 rupees. Opening cost, 100 rupees is liable at the time of opening of a new account. Okay, then reactivations. For example, if you don't invest at least 500 in a financial year, then your account will be inactive. In order to reactivate that account, then you need to pay penalty of 50 and along with that minimum of 500. This is a reactivation procedure. Next, interest rate. At present, interest rate is 7.1%. It is guaranteed. It is guaranteed by our government of India, and hence risk is very less, and it is called risk-free investment. Okay. Next, eligibility to open a PPF account. Who is eligible? Who are eligible for opening a new PPF account is Indian citizen. The person should be an Indian citizen. Next, one citizen can have only one PPF account. And I already discussed it in the feature part, but he can open another account in the name of minor. Next, non-resident NRIs, Hindu undivided families, that is HUFs, cannot open PPF account in their names, and also joint account is not allowed under PPF, except you can open another account in the name of your minor. Okay. Then, how to open a PPF account? Where to open a PPF account? You can open in post office also. Also, nationalized banks also giving the facility to open PPF account. In the recent days, Even private banks are also offering to open a new PPF account. So what are the documents required in order to open a PPF account? Let's discuss. First of all, KYC documents, for example, your Aadhaar, PAN, voter ID or driving license, etc. For your name proof. Next, residential address proof. You can provide Aadhaar also and DL also and voter ID also for residential proof. Next, nominee declaration form also you have to fill. Then passport size photograph also you have to submit while opening your PPF account. In these, that is post office, nationalized banks, for example State Bank of India, Canara Bank, etc. and private sector banks, for example HDFC and Axis Bank, also providing this facility to opening a new account, new PPF account. Okay. Next, what are the tax benefits available under PPF scheme? Besides every tax saving scheme, for example NPS, this only the tax saving scheme which qualifies for triple E provision, that is exempt. That means PPF scheme provides 3 types of exemptions. Out of that, first exemption is invested amount. You will invest 500 to 1,50,000 in the financial year. That investment amount can be claimed as a deduction under section 80C up to a limit of 1,50,000. This has been prescribed under our Income Tax Act of 1961. The maximum tax saving will be 1,50,000 into 30%. Why 30%? Because highest tax slab rate is 30%. Is 45,000 plus 4% of cess. Then you will get tax saving of 46,800 maximum tax saving. If you invest 1,50,000 and if you fall under 30% tax slab rate, then you will save 46,800 of a tax saving of amount. Then second exemption, that is no tax on interest earned. In a financial year, consolidated interest rate will be credited to your account on the date of 31st March of every year. That interest portion also exempt. It has been prescribed under section 10 of our Income Tax Act 1961. This is also exemption number 2. What is the exemption number 3? That is no tax on maturity amount. After the maturity, that is after 15 years, you will get a lump sum amount. That lump sum amount also tax free. So PPF account scheme provides triple E provisions. Exempt. This is best investment plan. Okay. Then, sir, PPF withdrawal, we have already discussed it in the feature part. One can fully withdraw the PPF account balance only at the time of maturity after 15 years completion. But the scheme permits an account holder to withdraw partial amount only from the 7th year onwards. Till 7th year, you cannot withdraw any amount. Okay. Then, for that, account holder has to fill Form 3 or Form C for partial withdrawal. Okay. Then, whether loan facility is also given under PPF? Yes, definitely yes. One can take a loan against his PPF account between 3rd year and 6th year. Because after 7th year, you will get a partial withdrawal facility. So, 3rd year to 6th year only you can take a loan against PPF. What is the limit of that loan? It can be restricted to 25% of the available amount. For example, in your account, balance is 1 lakh. Let's assume 25% of that will come around 25,000. You can take a loan of up to 25,000 against your PPF account in this example. And second loan can be also be taken before 6th year only if the first loan is fully repaid. That's a condition. First loan will be fully repaid, then only you can take a second loan. Okay, this also facility will be available under PPF scheme. To conclude, what is the conclusion? This is a very best investment scheme. This provides risk-free returns and also full capital protection, and it also qualifies for triple T, that is exempt. First exemption is under 80C deduction. Second exemption is interest amount is also tax free, and third exemption is maturity amount also tax free. This is the best plan for investment. If you start a new job or start earning, this is the best plan according to me. If you have any doubts, please mail to me and WhatsApp me in the provided credentials. And if you like the video, please press the like button. And thank you for watching till then. Thank you one and all.